Ever wondered how an entire economy can be shaken by something as mundane as home loans? Welcome to the story of the subprime mortgage crisis. Now you might be asking, what is a subprime mortgage? Well, simply put, it's a type of loan offered to folks with less than ideal credit scores. In the early years of the 21st century, these risky loans gained popularity. Why, you ask? A combination of low interest rates and a high demand for housing made them an enticing prospect for many. But it wasn't just the borrowers who were drawn in. Banks and financial institutions, always on the hunt for profit, also played their part. The result? A market saturated with high-risk loans. And as we all know, when you play with fire, you're likely to get burned. So with a market saturated with high-risk loans, it was only a matter of time before the bubble burst. And burst it did. The year was 2007, and the subprime mortgage crisis was about to turn the American dream into a nightmare. The housing market, once a beacon of prosperity, collapsed like a house of cards, triggered by an unexpected rise in interest rates and a sudden drop in housing prices. Homeowners, many of whom had been lured into borrowing beyond their means by the promise of low initial payments, found themselves in a precarious situation. As interest rates rose and housing prices plummeted, they began defaulting on their loans en masse, leading to a sharp increase in foreclosures. But the crisis didn't stop at the American borders. Financial institutions worldwide, which had invested heavily in these risky loans, found themselves bleeding red. The losses were severe, and the ripple effects were felt across the globe, shaking economies to their core. The fallout was catastrophic, bringing about a financial crisis that would be felt around the world. The subprime mortgage crisis was a harsh lesson in the dangers of risky lending and financial mismanagement. It underscored the significance of financial institutions in risk management. The crisis demonstrated that when banks and other lenders act irresponsibly, it can lead to disastrous consequences, not just for them, but for the entire economy. This crisis also highlighted the crucial role of government regulation in maintaining economic stability. When oversight is lax, it can create an environment where reckless financial behavior can thrive, leading to situations like the subprime mortgage crisis. Moreover, it emphasized the importance of individuals understanding the terms of their loans before signing on the dotted line. Many people were caught off guard by the terms of their subprime loans, leading to defaults and foreclosures, further exacerbating the crisis. The subprime mortgage crisis was a wake-up call to the world, a stark reminder of the destructive potential of unchecked financial speculation and irresponsibility.